Thanks for joining me today. I wanted to take the opportunity to comment on where we stand with inflation and the Fed's monetary policy. We saw the latest consumer price index release on December 12th indicate that the rate of inflation continues to trend lower. Headline CPI was 3.1%, and while this is above the Fed's 2% targeted rate of inflation, it's well below the levels that we saw back in 2022. And furthermore, some of the underlying components that have been applying upward pressure on inflation have begun to subside. Specifically, shelter costs have been driven lower by softening in rental units. And shelter costs are a lagging indicator within the CPI calculation. And so it was expected that that would take a long time to really begin to ease and allow inflation to come down lower. And we're finally beginning to see that. Fed Chair Powell, as recently as December 1st, was adamant that the Fed wasn't even thinking about easing its monetary policy. But then, after their latest FOMC meeting on December 13th, he executed something of an about face, and in the press conference afterward began to say, okay, well, the next logical thing to discuss here is the timing of interest rate cuts. And in addition to his comments, the projections released by that are collected by different members of the Fed's board about where they think the federal funds rate will be at the end of 2024 implies that there would be three rate cuts of 25 basis points each over the course of the next year. So as you'd expect, this prompted a pretty significant rally in both stocks and bonds. Yields on Treasury bills fell sharply in the wake of that press conference from the Fed, and the S&P 500 finished the day up nearly 1.4%. One could argue that the market had been anticipating a soft landing and therefore a softer Fed for a couple of months now. The S&P 500 had gained 14.6% since late October, and the market has increasingly coalesced around this soft landing narrative. We think that the Fed has a really difficult balance to strike here. Their forward-looking guidance is as much of a monetary tool as is the actual rate that they're setting. And so the sharp drop in yields that we've seen in anticipation of and then following the FOMC meeting are already in effect easing monetary conditions throughout the economy. Consumers will have greater access to debt for mortgages and auto loans, and businesses will feel less and less of the pressure of a higher interest rate environment the more that yields continue to fall, even if the Fed has not cut their federal funds rate at all yet. And so on the one hand, it's encouraging to see the rally over the past couple of months. But I don't think that the Fed is declaring victory on inflation yet, and so we don't think that investors should necessarily assume that this is the end of inflation and Fed-driven volatility either. If broad inflation measures, or the underlying measures that contribute to inflation begin to retrace their levels that we've seen over the past 12 to 18 months, then it could easily compel the Fed to entrench in a higher for longer position, or perhaps even announce another rate hike. And if this were to happen, then it would certainly spark volatility in the markets. And we think that a higher for longer mentality or an unexpected rate hike would almost certainly send stocks lower and bond yields higher. It's tough to predict the future. We could easily look back 6 to 12 months from now and recognize this week as a true pivot, a true turning point in the Fed's war on inflation, and more confirmation of strength ahead in the markets. But it could just be a blip on the radar, and it could be that inflation remains persistently high, and the Fed feels like they have to keep tighter monetary conditions in place for longer. And so that combined with a handful of other things, the first thing that comes to my mind is the next year's an election year, certainly creates a lot of opportunity for volatility as we go forward. But I think that all things being equal, investors should be rather encouraged by what we saw from the Fed this week. and that at least they're thinking about the prospect of cutting rates, because it does seem like it's making this soft landing prospect more and more attainable as we move forward. But time will tell. If you have any questions, please contact us. In the meantime, we appreciate your time, and we look forward to talking with you again soon in this format.